I am so excited about this episode of In the Money with Amber Kanwar because this is like sort of a dream team that I've assembled here. I've got John Zechner of J. Zechner Associates and my mentor, Frances Horodelski, who I've known for a very long time, and I dragged her out of the cold to join me. Thanks so much to both of you for joining me.
Happy to be here.
Great to be here. Great to be here with John because I learn a lot from him. And mentor makes me feel old. So perfect.
We can all be mentors. Wise. You're both very
Frances,
wise.
we are old.
Yeah, well, that's true.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Okay, well, we're going to use that wisdom and put it to practice in the portfolio because there's so much to talk about. And I want to start, let's talk about what everyone's talking about. And then the great thing about you two is you get really in the weeds about stuff that no one is talking about, but maybe should be. So obviously the first one is tariffs, the terror of potential tariffs. John, as somebody who runs money, you have to make a decision about what are you going to do in the portfolio? Where are you going to be exposed? How does tariffs factor into that thinking? Because it's such a wild card.
Wild card was exactly the word I was going to use, Amber. And it's hard to be in front of this. I mean, you really have to take a more cautious approach until you hear what he actually does. I mean, I tend to think Trump is not going to be able to deliver anything close to what the promise he did in the election, and maybe we'll see that on the tariffs, but you don't know it right off the bat. In the meantime, the stock market creates opportunities. It's doing it. Some of the industrial stocks, you know, the big traders are getting hit. Look at what's happened to Bombardier and names like that, the auto parts companies, NFI, a lot of companies have, you know, the steel company have been hit pretty hard. So the oil companies, so it'll create opportunities. So watch for it. You know, what the reality is, you don't know, I don't know, and we've been down this road before. We've seen it, and you know how it ends. I have no idea, but the market will create opportunities for us.
And that's exactly what I was going to say. We kind of went through this in 2017, 2018 with the renegotiation of NAFTA. We did come out of that. You know, we had to give up, but we came out maybe stronger as a country. And I'm thinking about Canada. I don't want to talk about China at this juncture, but we're, you know, focused on Canada. That's number one. Number two is that, I mean, I guess everybody is saying that Trump in the end, President-elect Trump in the end will be less aggressive in the tariffs. And maybe that's, you know, fingers crossed. But, you know, he has some pretty interesting people, including the new Secretary of the Treasury, who seems and was in his confirmation hearings a little more measured. Mm-hmm. So there might be a lot of noise, and then maybe, you know, again, fingers crossed, it will pull back. Nobody wants a tit-for-tat tariff war. I was reading up on Smoot-Hawley. I mean, we're old enough to know about Smoot-Hawley from 1930.
Give us the background for those that are not old enough.
It really aggravated the Great Depression in 1930 and through the 30s because of tariff wars. So nobody wants that. The Americans don't want that. The smart people don't want that.
Okay, so what do you do in your portfolio? Are you just staying invested? Because this is also a guy who loves the stock market and views the stock market as a real-time indicator of his success.
It is his report card, and we know that, but sometimes you just can't fight the inevitable. I mean, look at 2018, where, you know, his policies of 2017 were very expansionary, but ultimately then, you know, get a little inflationary and started pushing interest rates higher, and his new secretary, or his new Fed chief, Jerome Powell, who he appointed, suddenly he didn't like, and he was almost firing at the point because Jerome started raising rates as he should, and we had pretty significant downturns in 2018. So I don't think
rate increases are going to be on the agenda unless something wild happens.
No.
And you used the word wild before, but
so maybe not rate increases, but is there a chance we don't get any rate cuts this year? So there's tariffs. That's one thing to consider. I'm looking at inflation data that doesn't suggest that the Fed should be in any rush to cut rates. In the market, I think right now, June, right? June is where they think
Maybe one.
Yeah.
maybe one. Is that a headwind given that we've had like interest rates actually going up at a time where the Federal Reserve is cutting rates? Like, is that a headwind to stocks?
I think the reality, if they get to that, then they don't increase interest rates. It would be tough on the market. I think you've seen that reaction in the past month. And look at it. I mean, what turned the market down in December was in December 18th when the Fed came out and really was a little bit more hawkish going forward, and they went from 4 to 2 rate cuts next year, and the stock market has struggled really since then. So yeah. It could be a problem.
It's struggled in aggregate, but you mentioned this word, John, opportunities. And the rotation, which I use this term all the time, is the lifeblood of stock markets. And we've seen that rotation. So something gets way out of whack, gets pulled back, something else fills the void. Over the last couple of weeks, it was actually energy. Who knew in December, when oil was in the 60s, that in January it would be in the 80s, or almost. Depending on what crude you're looking at. So you got this opportunity to buy low, maybe trade out a little higher. So there's this rotation that's providing all this kind of opportunity while we figure it all out. And we're going to be figuring it out probably over the next 4 years.
And you know, Amber, you mentioned at the beginning, what are people not talking about, or certainly not talking about in any positive way, and we've been buying, is bonds. U.S. bonds in here.
Why?
Interesting stat. The 10-year Treasury in the past 25 years has traded above a 5% yield for 20 trading days. 20 trading days in 25 years has been.
That's it?
That's it.
Like, I want to underline that point because people say if we get to 5%, that's it.
It's
We're
the
gonna
average
blow right through.
for decades.
It is, but I think you can take a lot of sort of the pre-2000 period out because of different inflationary environment now that we've seen, you know, for the past 20 years. So, you know, from that point of view, I don't think rates are going in the U.S. above 5, and so I'm looking at 20, 30-year bonds. So I got a little bit of 20 basis points of downside risk. Otherwise, I've got upside, and it's a great hedge against the stock portfolio. If the economy is weaker than we expected, if you have a bit of a bubble collapse or anything in the stock market, bonds will benefit. So I think it's a great hedge in the portfolio right now.
But that leads me to a question that everybody is talking about, but not sure what to do with it, is the strength of the U.S. dollar and the weakness in the Canadian dollar. So everybody hates the Canadian dollar. I saw something the other day that there was 0% bulls on the Canadian dollar. Pretty easy to understand why we're a mess, or the headlines say we're a mess. But you buy those U.S. bonds, what are you doing? Are you doing it unhedged? Because that dollar, their dollar, and they speak out of both sides of their mouth on the U.S. dollar. We want a reserve currency, but we don't like it strong. You can't have both ways. So,
no, you can't.
So how do you do you hedge that? Do you just do it with your U.S. money and say, this is my U.S. money, going to keep it in U.S. dollars?
I think you got to be wary of how much you've got in U.S. dollars in any portfolio. I think most investors really have to look closely because if they haven't done anything, they're a lot more overweight U.S. stocks than they've been in the past and U.S. dollars in general. And I think as well, just like the end of the 1990s, you saw the Canadian dollar actually start to rally when everybody hated it the most and the U.S. dollar sort of hit that peak. Because, Francis, you would remember the old purchasing power parity. They call it PPP.
Our dollar is so cheap. Look at anything. If you go into a U.S. store and I'm on my bacon or pork chops or whatever, ground beef in the U.S. is exactly the same price as ground beef is in Canada, dollar for dollar, but it's a 40% premium. It does not make any sense.
So that speaks to what?
The Canadian dollar is dirt cheap, and theirs is way too expensive.
So that brings us to what's also happening in the markets. Is that the U.S. market is growing, and as a proportion of global stocks, is taking up a huge amount. It's really been just a runaway train compared to other stock markets around the world. is 2025 the year that continues, or that some of these dirt cheap areas like Canada start to outperform? And by the way, I think I ask that every single year. Is this Canada's year?
Well, we did have a decade of ourselves,
That's true, yeah.
post the tech boom, and when global commodities started moving, when the global economy started moving, Canada did better. The currency got better, so it's not unheard of on a valuation basis. We're as cheap relative to the U.S. as we've ever been. I think we've got the potential for some earnings recovery on a global basis because some of these economies already went into a downturn. You look at Germany, you look at Japan, you look at Canada, and everyone except for the U.S. And I think they've been protected a little because of their excessive deficit, which is sort of finances growth. And I think the wealth effect in the U.S. is huge too, just because of the move in the stock market. Nothing goes in a straight line in that direction forever like that. It is reverse. Getting that timing right is hard to know, but
in your portfolio right now, are you more U.S. or more Canada?
I've been moving way more to Canada away from the U.S. recently.
Why?
Just the valuation difference and then the potential for improvement and the risk mitigation as well. I look at Canadian energy stocks, telecom stocks, even financials. I don't see the same sort of downside in a downturn if it starts ending in the U.S. And the U.S. has really been driven by passive investments, the ETF flows. And people don't get it. When they put $100 into the SP 500 or the SPY, the big ETF, you're putting $30 of it into the Magnificent Seven, which is why you raise their valuations. If you ever start to unwind that, it's gonna go in the other direction just as strongly.
Well, let's get into our mailbag because it is about the energy sector. Would you prefer ARC Resources, Tourmaline, or CNQ for a very long-term hold? This one is coming from Tim, and he wants to know, like a 10-year hold he's talking about, and he wants to know if it's a good idea for an RSP where he's looking for some growth, but mostly dividends. What do you think, John?
You know what? They're great quality companies, all three of them. Tourmaline Micros have been probably the best operator in the light oil, natural gas side. Tourmaline has a higher valuation, so I'm always a little more valuation driven, so I'd probably move towards ARC. ARC has a nicer mix of gas as well as light oil. Tourmaline a little more geared towards the natural gas side, which is still a little restricted in Canada in terms of the movement. Canadian Natural is the great operator on the oil side. It's a premium to some of the other oil players. They delivered on that, but they're tied pretty closely, obviously, to the heavy oil, the oil sands. If push came to shove and I had to take one, I'd probably take ARC more based on the valuation.
What do you think? And do you have any thoughts on the huge move we've seen in natural gas after being dormant for a really long time?
Well, there's a lot of, as with all things moving parts, there's the weather, which has been exceptionally cold. It's going to stay cold. There's the disruption in Europe. So while a lot of our natural gas doesn't go to Europe, some does, but it's that vacuum that it creates globally. There's a lot of seasonality in natural gas. We are the best source of natural gas maybe in the world. And I do like Tourmaline. I own Tourmaline, but it is expensive. But you pay for micros, so what do? And you pay for the special dividends that keep
exactly
coming.
it. If the question sort of centered a little bit more on the dividend payout, they've done the special dividend, they've increased the dividend, so they've returned a lot to shareholders on that basis. Francis's point is really good about Europe too. I think people shouldn't lose sight of that. I mean, obviously the fact that Russian gas can't go across Ukraine right now, Europe is sort of starving themselves on that basis. Will pay a premium. Problem for Canada, it's still somewhat a localized market. Until you can get those LNG tankers fully, loaded and moving out, we still produce more gas, and Canadian gas will still be at a discount to, global gas prices. So you might see $4 an MCF on your screen in the morning for what's trading on NYMEX. I tell you, you're not getting that in Canada.
So then where do you go? Like, what's the best play?
In the oil patch, I think drillers, to be honest with you.
John?
Oh, beyond those three, but I think drillers.
Yeah.
Yeah, I still gravitate more towards the oil plays. I'm valuation driven. 3 times operating cash flows, only 15% free cash flow yield. But another interesting story on the nat gas side too is energy generation in the short term. The nuclear story in past year has been huge because of the restart, a lot of the large facilities and everything else.
And that's AI driven, right? We need energy.
Exactly. That's for the data
so that's
centers.
why nuclear
That's a good long-term story. But getting nuclear up and and running is a decades, multi-billion-dollar process. You can you get natural gas-fired electricity production up and running much more quickly, and that could really be a boom for. That's why you saw Capital Power in Alberta be such a great stock over the past year.
I guess I wonder about that energy consumption story, because ultimately, huge demand for these data centers for power, whether it is not gas driven, whether it's hydroelectric driven or nuclear power, is that sometime down the road, and I don't know when this is going to be happen, is there's going to be an energy crunch. And that's because, Microsoft's buying up all of this energy. Amazon is buying up all this energy. But what about Mrs. Jones, who has to light her home or heat her home? There is going to be a real, I think, difficulty down the road as, these big corporations hoover up this energy. If AI demand goes the way people are thinking, of course.
And
that's
electric
always
vehicles
debatable.
and everything else.
I
Supportive of oil, all those people who think peak demand is around the corner.
Well, we've heard of peak demand for a while. I mean, it just doesn't need to rise, and there's so many places that aren't gravitating there that quickly. But I mean, Francis's point on the data center is interesting too, and the ultimate demand for electricity. But you got to be careful. This is not an infinite growth period for what you're seeing. Look at the hyperscalers and what they're spending. It is more of an AI story. We're not talking about millions or even billions. We're talking about hundreds of billions of dollars that these guys are spending. You can't continue that indefinitely.
Until you get a return on the other side.
Until you get a return on the other side. And I don't know whether we'll see it. So at a point, you'll hit capacity just like we did in 2000. Remember global crossings? Well, whatever happened to them?
I was thinking of that story with respect to Enron, actually.
Yeah.
And not that we're talking about any company that's like Enron. That was a fraud. But I do remember being on the desk, and I believe it was Business Week had Enron on the front cover. It might have been Barron's. Saying basically that Enron was going to rule the world and nobody's going to have any energy ever again. And of course, a year later, after the big parties, the thing blew up. So it's always good to remember that things don't go in a straight line.
You can overbuild capacity, and then you have to eat that capacity some over time, and that's what leads to downturns in the market as well.
We haven't seen the applications, and like the ones that we have seen, some are really cool.
Yeah.
But some are far from what they've promised.
And what are you paying for them? I mean, Chat GPT, I get for free now. You can just download. I mean, you get all of that stuff. I mean, I watched Matthew McConaughey out there sort of pitching Agent Force because suddenly Salesforce is going to be the dominant player there.
I just watch Matthew McConaughey. I don't know. I don't have to hear what he's saying.
Right. Well, he's pitching a big AI product.
I know.
But in the end, I don't know that they will deliver.
My AI play is going to be Google right through the piece, because I think ultimately they're going to be the winner in the AI story. I'll leave it there.
What do you think? Google's the winner of AI?
I don't know that. I'm still betting that, but I think the other users will benefit more. You look at the healthcare industry, look at the financial industry, the way they can implement this. There's lots of it. I just don't know that we can get to that number. If you've got $2 trillion of CapEx out there to get an ROE of even 10% on that, you need $200 billion in annual extra revenues each year from these services. I don't know if I see that right now, and there may be the various software and the cost savings and the productivity improvements. So yeah, it's we may be a little ahead of our skis on that one. So
the question was about ARC resources, but we really, and this is why I love these two, because you can just be on a journey with them. So I'm going to bring them back to the road, and we are going to take another question. This one's coming from James, and it's also important, and I bet we'll take it a million different ways, but it's about BCE, which of course is the cell phone company, the telecom company in this country, one of the three major telecom companies. And the question is about all the noise regarding should BCE cut its dividend. It's got a very high dividend yield, and they've done things to try and adjust it. But even then, it seems like it's on an unsustainable path. And while analysts might advocate for the cutting of the dividend, this viewer, James, is saying that given Canadians' dependence on BCE dividend versus just the share price, who lobbies the board on not cutting the dividend? Basically, his point is like, so many everyday Canadians rely on this dividend for income. At what point, does that sentiment just become difficult to justify given, the dividend is just, the yield is too high? What do you think, John?
Investors have to be wary. When a stock is giving a dividend yield of, what is it, 11%, 12%
this morning.
What it's telling
12%.
What it is telling
just
you.
By the way, for a blue chip company like of this size and magnitude, you get 12% from like an oil and gas or like a speculative play. You don't get 12% typically from a telecom like this.
Well, and that's my point, is if you're getting a 12% dividend yield, what the market is effectively telling you is that the dividend is or should be cut. So, I think, they could free up some capital and not take a necessarily big hit. I don't think people buying BCE or owning it should necessarily be counting on that they're going to continue to get a 12% dividend
But the
yield.
problem is that they bought it at 50.
Yeah.
They're not buying at 32. And they bought it at 50 when the dividend yield obviously was substantially lower. So to your question, that is a problem for people who currently own it, because they bought it at 50 for the regular, ongoing, consistent dividend with a small growth. That growth is non-existent in 2025 because the company's already told us that. And so the big question for me is how many people, and this is if you wanted to buy it today, not if you own it. So how many people, money managers, institutional owners would be willing to sell it if they cut the dividend? How much risk is in the name? It'd be great going forward. Maybe they cut it in half. It's a 6% yield.
Do institutions still own it?
Oh, in a huge amount, absolutely.
You can't not own it.
Yeah.
You can't not. It's just too big to only be owned by retail.
I mean, you'd think at some point they would have cut their loss. The stock was around $70 in 2022. Now it's around $30. It's trading at the lowest level since the financial crisis. Like, the heart of my question is like, is the institutional ownership still there relative to the retail crowd that is there for the dividend?
Oh, absolutely. I'm sure they are. It's still a big index play. It's still part of it. It's in core portfolio. So, yeah, I think everybody owns it. But
And it's not just been a BCE issue. TELUS is under 20.
Rogers
has been under pressure. So you've got the
But they don't have the yield problem.
They don't have a yield problem. TELUS has a bit of a yield problem. Rogers has does have a leverage balance sheet, and of course they went and bought the sports assets
Maple
from
Leaf
Bell.
and entertainment.
So their debt isn't terrific. So for me on BCE, I think you need I don't know if it's an activist in there. You do need a trim of the dividend. I don't think you cut it in half.
No.
You need a strategic plan because you're in a slow growth environment for the company. I mean, immigration is rolled over and will continue to roll over. You have competitive environments from satellite and the like. You have cable cord cutters, which is going to eat into their business. So I don't really feel that they have a strategic plan. And I don't think buying fiber in the U.S. is the greatest plan in the world.
The market didn't like that deal, and it sold off.
It liked it for about a minute, and then it sold off again. So February 6th is the company's...
I mean, you have to keep in mind rates, too, have not been friendly. So when interest rates are going up, that can be difficult for these stocks.
They've not been bad in Canada, actually.
Yeah,
so
that's
on
true.
a competitive basis, Canada's not been bad. So February 6th, they're going to be reporting their fourth quarter results. They're going to be providing their 2025-2026 outlook. And that's going to be crunch day for the company.
And the stock keeps going down, but I'm a little on the other side of what they're doing. I'm less perturbed and disturbed by some of these moves. Like the MLSE deal makes some sense when you took the exact same dollars and you put it into a core business that makes more sense for you. That's closer to, it's in the U.S., maybe there's not as much success there, but I think that is a better chance of winning for the longer term. Selling it to Rogers makes a ton of sense for Rogers too, because Rogers will monetize this. The more they get, then they can get the whole thing together. They can put it out publicly. Look at the value of sports franchises right now. Like, there's no way they're paying Otani like $600 to $700 million if the sports franchise franchises themselves aren't worth a tremendous amount. And so, yeah, it's significant. So I think there's great hidden assets here. Markets do this. Markets love stuff and then they hate stuff. And
So
sometimes
would you buy it?
I would buy it. I'm absolutely
You're buying
buying all
BCE
three of them.
here.
Yeah, I've always, for doing this for 40 plus years, you got to figure out what you're good at and what you're not good at. I've never been.
I don't think BCE has figured that out.
I'm not.
That's a
I'm
problem.
not good
I
at
own the stock.
Yeah.
I wish I didn't, but I don't disagree with kind of the contrarian play. But I don't see that BCE has a strategy.
It's
That's my problem.
cash flow generation in their core businesses that generate. When I look at what they're doing in wireless, wireline, the growth of streaming, and you're limited to the number of players you got up here too, and you monetize the
Unless we
assets.
become the 51st state, and then we've
Yeah.
got to all of a
Yeah,
sudden
well,
got to
that's it.
compete. We've got to compete south of the border. But I'll leave that
Wash
there.
your mouth out.
I know. See, this is why. This is why you're my mentor, because you say things like that. Okay, so we're going to put that one to rest. Now we're going to move to tech. This is a question coming from Grant, and it's about Lightspeed. Lightspeed was a high-flying, I guess we can call it tech stock. It's a point-of-sale company. In 2021, reached a peak of $120 US. It is now down about 90% since then. I think I'm going to capture the history on that. The founder CEO stepped away in the intervening years, then stepped back in when the stock imploded a couple of years ago, really laser focused on being profitable. And then there was, I think, a trial balloon on, are we going to sell the company? Is it going to go private? So
A strategic review.
A strategic review, which is often code for let's see if there's a buyer. Did I capture?
Yeah, that's pretty good.
The
Yeah.
history? Okay. So the question is from Grant. Actually, it's a bit of a fanboy for John. Thank you, John, for great tips and opinions over the years. I'm a big fan. A while back, I believe John was keen on Lightspeed. What is his current outlook on the stock, and do you still hold it?
We do, and it's interesting because one of my cardinal rules I'm breaking here, because I always say don't buy value in technology. It means the growth story is over and has gone down. But we got into Lightspeed not that long ago, and it had a bit of a run off the Canadian $20 level when Dax da Silva came back. And when they talked about, restructuring or, corporate activity or something like that. And that review, strategic review you mentioned, Frances, is taking longer than I would have expected, which makes me a little bit concerned. But having said that, when tech companies start to do well is when the cash flow starts hitting this break-even level and they go through that. And then you can leverage all of that spending more to the bottom line. They have just started moving to positive cash flow, which means
there's two potential catalysts. One, they do what a lot of Canadian tech companies are doing and somebody else buys them.
Right.
Or two, their financials are improving.
They are, and they're already, quite inexpensive. 2 times revenue for a tech company that's generating positive cash flow is cheap. I mean, I guess the risk is, do you get marginalized within your own business by other players, Toast and others who are sort of in that field going to sort of take a bigger share of the market from them and marginalize them. I don't know. I think that's probably the risk in the company. But with the balance sheet, the valuation, the restructuring, I think that it's worth a shot. So it's not our top name in tech, but it's certainly in the Canadian portfolio, and I've added to it.
I'd agree. I think it's worth a shot. Yeah. I mean, it wouldn't be. And the growth, actually, every time they've reported numbers over the past 4 quarters, those numbers have come in a very healthy fashion from my recollection. It is cheap. I don't disagree either with you, John, on buying cheap in tech is a tough one. But sometimes they work. And
Well, you know what I bought?
What?
Can I share with you?
Yes.
I bought BlackBerry.
Oh, yeah.
A
but
couple
it's
of
not
months
cheap.
ago.
It is
Worked out
not
well.
cheap.
It did turn out well.
Oh, yeah.
And so now I'm up like 75%. And not for any reason. I just thought they're not valuing this. Fine, it's not cheap on those multiples, but I just felt like there's value there. There's a business there. And it was trading like it was nothing.
Yep.
It's that core auto business is probably what makes them the most. The Internet of Things. I mean, the cybersecurity. I mean, they did a great.
I'm less confident now that I'm sitting on a
No,
big
I mean,
gain.
it's getting out of silence. I mean, what they pay almost $2 billion for it, and they walk away with $150 million 5 years later. They just never were competitive on the cyber side. But the Internet of Things and what they do in the automobile. I mean, you look at your dashboard. I mean, this is all BlackBerry-based product.
Okay, let's get to our next question. This one is about Laurentian Bank. This is one of the smaller Canadian banks, another company that tried to sell itself. This one did not work out. In 2023, it said, we're going to do the strategic review. That's code for we're going to try and sell ourselves. There were no buyers, though presumably a lot of the big 5 Canadian banks kicked the tires. And so when it was revealed there are no buyers, the stock fell from above 40 to where it is right now, around $30. So it was below that when the news initially came out. This question is coming for the fabulous Frances. It's from Cheryl. I have a question for the fabulous Frances. Do you think Laurentian Bank will be purchased by one of the bigger banks?
Well, I mean, they must have all kicked the tires. And as Scotia's going to the U.S., National bought
Canadian
Western, Royal bought HSBC. BMO's got their hands full. TD's got their hands full. Is Commerce interested? I don't think so. So, no on that count unless something remarkable happens. A couple of things with Laurentian Bank, and it sort of reminds me when Citi was imploding. The valuation of Citibank, and it still is actually, Citi still trades at a discount to book value. So you don't get that opportunity much to buy a bank below book. So that's number one.
But that's Citi. Citi is like a major bank. Laurentian is small.
Well, that's right. Exactly. So there's a reason for the discount, but it's still at a discount. It's about half a book right now. So you don't get that opportunity. Number two, they're really focusing on cost reduction, and that's a long road to hike for sure, improving their technology. So, it's working with the things that they can change and affect. They've got a new management team, so that's good. The dividend is high and more than well covered by the earnings that they currently produce.
6.5% dividend yield.
Yeah. So, I actually own it. I didn't buy it at 40. I bought it at 28. So, I'm in the money by a buck. But I think that...
Good use of the show name, Frances.
Yes. Look at me.
There you go.
But, it's for me... It's like National Bank forever. Nobody wanted National Bank. Oh, it's a Quebec-based bank. It was dirt cheap for a long time. This is a long-term play for me. I think you're going to get a decent return.
That's a good point. CIBC was the same thing a year ago too. Discount valuation, and suddenly you do put a couple of good quarters together, and it changes. But Frances' point on, and I think it's anything to kick the tires. When this strategic review first came up, I like this. For Bank of Nova Scotia, it seemed natural. They're pulling their horns in Latin America.
So natural, didn't it?
And then they looked at it, and all I kept thinking when they all looked at it and walked away, I thought there's something in the book of business that they didn't like. There's something in the structure or the cost, whatever, that all of these guys looked together. Otherwise, there's not that many assets in Canada. You went through them all. They're all being bought up on the financial side. There's not many players left to buy. So why didn't they buy this one? And
Quebec in the case.
Yeah.
Maybe it's as simple as that. I don't know the reason either. Yeah, and that's why the stock got pummeled, because there was an opportunity to consolidate, and maybe, and I don't know this, maybe the regulatory authority said, no.
Can we really, you think, and said yes to Canadian Western?
I don't know.
I don't know. Can we name our favorite bank stocks?
TD right now.
Good for
I've
you.
been buying TD.
That would be the turnaround play. That would be like that old worst will be first, right? The worst performing stock of last year will be the best performing.
I think the Canadian business is still absolutely fine. They may not be able to expand anymore in the U.S., but they got that great business in New England. So and
maybe
I think
buy Laurentian.
there's a lot of low hanging fruit.
Schwab.
Selling Schwab could be great because suddenly you're overcapitalized. You could go into a massive stock buyback as well.
They own 10% of Schwab, and a CIBC analyst recently wrote about, well, what if they sold it?
Yeah.
Exactly to your point, it just
gets
goes
them
to
nothing
buybacks.
right now. It doesn't do anything really for them anymore in the U.S. because they don't have the broad exposure to get to sort of use that. So
I guess, and I like a contrarian play as much as the next guy, but it really is, where does the growth come from? So they are constrained in the U.S. for sure, and that's going to be for a while. If Wells Fargo is any example of how tough the regulators in the U.S. can be. So it's not going to grow much in the U.S. Canada, kind of saturated unless they buy Laurentian. Let's start that rumor.
Yeah.
That's not going to happen. A big buyback is a good, financial engineering opportunity, and that could get the stock into the 80s. It's not my favorite. I think BNS is my favorite, as
Scotia,
Scotia as the last will be first, and it's been last for a long time. I think Mr. Thompson's doing a pretty decent job.
Growth is constrained in all the banks. I mean, it's a mature business. They own the home market. It's not like you can do a lot of acquisitions. So I think they all face the same thing. So, what do you do in that basis? I think you do have to go the route of recapitalizing and getting more back to shareholders, doing share buybacks and whatever just to get a higher return.
It's sort of Canada, actually. I mean, we only have whatever it is, 40 million people, and that might be shrinking.
You know what? And we're going to pick this point up. We're going to have to take a quick break, but contrast the Canadian banks with the U.S. banks, which all reported, and they're going gangbusters. Before I do that, I want to just squeeze in one question. This one coming from Dennis, kind of taking us on a bit of a left turn, but it's about Russell Metals and wondering why Russell Metals is down more than 10% in the last month. Is it Trump's, tariff threats, the acquisition of Tampa Bay Steel? Any quick thoughts on that, John?
It's absolutely the tariffs. I mean, they're so exposed to that, obviously, and where they are is sort of the mid-market in steel. I mean, that's nothing. That's going to get decimated if they did 25%. Tariffs go through as projected.
Are you going into these kind of really obvious victims of tariffs? And you could say it's Russell Metals, you could say it's Nike, you could say it's Constellation Brands, right?
Magna.
Like you could say it's Magna. Are these, even though you're invested, are you staying away from these particular names that are caught up in the storm, or do you view it as a buying opportunity?
No, we're nibbling at it. I'm not confident enough to go in a big way, but we took a little bite of, Algoma Steel recently just because of all that's going on U.S. Steel and all of that. It's just so ridiculously cheap. There are a few names like that. There's Bombardier. I mean, they got a great business. Obviously, you can't. Their biggest market for the corporate jets is the U.S. So if they get the tariffs there, that'll decimate them as well. But they otherwise are on a decent growth path.
All right, we're going to take a quick break, take a trip down south, and talk U.S. stocks when we come back. Welcome back. We've still got a couple of questions for John and Frances. Our first one in this segment is about the U.S. banks. A bunch of them reported quarterly results. They all beat expectations. But with the group near all-time highs, would you add here or would you keep holding on? That's from Dave in Pickering, Ontario. What do you think, John?
I'm not adding in here because, they had great quarters, but you look at it, capital markets are exceptionally strong. The U.S. economy is still really going gangbusters at this point. The yield curve is sort of normalized, which is always positive for banks. So, if you don't beat your numbers in that sort of environment, when are you going to do it? So it's more going forward. And people have already sort of put in higher expectations now and higher valuations because of expected deregulation. So I think there's a lot of good news built into financials. So I'm not really, we're sticking with the names, but we're not really chasing anything.
Like what names?
Well, Citi's our top name right now still. So, and we just the big players, because I think when you look at those, we were talking about the constraints in Canadian banking before. U.S. is just the opposite. You got 4,000 banks in the U.S. I think there's a lot of, sort of things to be picked up along the way. And you look at what happened last year, 2 years ago, I guess now in California as well, and where you can sort of pick up the, what's the name of that one again?
Silicon Valley.
Silicon Valley Bank, things like that can't get funding and whatever. So I think consolidation opportunities, but those benefits will accrue to the larger players.
I guess the big thing is, and I just own one regional bank, Fifth Third. I did own Bank of America. I sold it too early, probably, but they aren't particularly expensive. I think the regionals are a better play. I think you're going to see a ton of M&A in the banking sector. To your point about the number of banks, and
also like the Trump effect, right?
And
he's going to deregulate,
and that's going to be going to be the benefit is the deregulation. Maybe less capital required. There's going to be a bunch of little things at the margin, technical things that could help the banks, but I mentioned this earlier, and it's that rotation effect. So coming into this week, we had about 0%. I love this stat. About 0% of the S&P 500 Financial Services Index was above the 50-day moving average. hugely oversold. And what did we get? We got good numbers and we got the big rally. And I think that's
What's
what
another sector that is like that before the rally?
Housing, the same thing. Housing was 0% of the housing sector of the 38 names in the XHB.
Which is a home building ETF.
That has
XHB.
Lennar and Home Depot and all kinds of names like that. There was just one name above the 50-day moving average. That was Williams-Sonoma, and that's really not a housing stock, although it's in that index. And now we have the same thing in U.S. real estate. I tweeted about this recently. 0% of U.S. real estate stocks are above the 50-day moving average. That is oversold in my book. You got a real estate developer coming into the White House, for goodness sakes. And the other is consumer staples, where it's right now about 13% only of that index above the 50-day. And why in consumer staples? Because you're never going to smoke again. You're never going to have a chocolate bar again. You're never going to drink a Pepsi again, apparently. And as I said to somebody this morning, I'm going to want a drink and a cigarette and probably some chips over the next year as the Trump administration makes me pull my hair
And
out.
those stories reverse. I mean, to your point,
They
too.
do,
I mean,
and they're not
housing-
expensive.
The housing stocks, I mean, are trading at, 8-9 times earnings for, Toll Brothers, KB Homes, some of these players.
And they
So-
need housing. They need 5 million homes in the United States. They're underbuilt by 5 million homes.
We've got Netflix reporting this week. Marty in Nova Scotia, is there any reason not to own Netflix?
I can't think of one right off the top that says, I like their business model, like where they're growing, and I would just diversify more of a few more names in the. I think Disney is a great play. They're picking up a lot.
love
I don't even like you. I love you. Actually, I love you, John, because I love Disney. We are way too agreeable.
Oh, we got, I've got all the services. I got Paramount Plus. I've got all of and I got Prime. If push came to shove, and I get all the family on them as well, we said we could only keep one. I think Disney would be the one they'd probably all rally
Over
around.
Netflix?
Over Netflix, right? But there's, I think they will all do well. They're all starting to generate positive cash flow,
Yeah, but
and it's at the
Disney's
expense of
problem.
the.
I mean, Netflix has figured out how to be profitable, right? Finally, and now it's just a free cash machine, and it seems like it won the streaming wars. Disney's got fine. They're trying to make that business streaming profitable. Now, all of a sudden, it seems like they've got to slow down at the parks, which, as a mother of 3 children, I don't see. I still have to, shell out thousands and thousands to go there. But it seems like they've got to slow down at the parks. Isn't that a lot of problems there at Disney?
That's a consumer
and apparently,
side,
no one else can run that company except Bob Iger.
Yeah.
Well, they've got a transition.
Yeah.
They're looking at a transition.
There is economic sensitivity at the parks, clearly, and all of that. But the biggest thing about Disney over decades has been cross-selling. I mean, and it all comes down to all of those companies is content and what you own. And I also think Disney is a top on content from what they bought from Fox, from Marvel. Nobody is sort of beating them in terms of that. Netflix has to continue to rebuild them.
Movie? I'm done. I'm ready for real movies.
Apparently, people continue to go. I don't think I've ever been to one, but people continue to go.
But you know what the interesting one is on the streaming, though, is Disney owns ESPN, obviously, but sports is obviously huge. And now you got Amazon and Netflix both going for the NFL broadcast. Have you seen that recently and what they're paying up and the viewership they're getting for? So, the Disney, and back to that point, is positioned as well as any of them for a lot of the things that are popular and paying off. So, streaming is here to stay, and you want to own the major players. Whether you take a run at Paramount, it'll get taken out at some point. Where there's a lot of different players in there, but Netflix is the biggest. It's interesting. Netflix obviously has a better international exposure as well.
Let's end with this question. This one coming from Stephen Oshawa on a name that really galvanized America. It is United Health. It reported quarterly results, missing revenue expectations actually for the first time in 4 years. But of course, everybody knows about United Health recently because the United Healthcare CEO was gunned down. And that created this kind of movement in America to look at healthcare. It also took down the stock. Now the stock kind of drifted up into earnings, but That is such a
Visceral reaction.
visceral, like that's a big cloud around a company like United Healthcare, which typically isn't that in that kind of, everyday discourse. As an investor with your investor hat, what does all of this mean to you?
Well, there's a lot of risk in healthcare right now, regulatory risk, particularly, who's being appointed by Trump, Robert F. Kennedy. So you don't know what the policies are going to be necessarily coming out of there. The pharmacy benefits management business have been difficult and money losing for a lot of the Cigna, a lot of the other major players. But, the valuation reflects it. I wouldn't put UNH at the top of my list on that one. What we've been buying recently, and it's run up a little bit, was CVS. Because sometimes the easiest problem to fix is get rid of money-losing businesses. And I look at CVS and I think, okay, their core, you get rid of the money-losing businesses right now, you're generating about $8 a share in earnings for a stock that's trading around $50. So there's opportunities, but it's value, and no one sort of wants value right now. But I think, when everyone hates it that much, this is the time to start looking at these names.
I did actually buy CVS. I'm down on it, but I'm curious how you think about CVS versus a Walgreens.
Walgreens is the cheapest stock in the S&P 500 right at the moment, like, I don't know, 5 or 6 times. A lot of warts on it in terms of the retail side of the business. CVS has the managed care side, which is maybe in a better sweet spot. When you look at that business, though, and you look at the health insurance business in the U.S., it is so complex. And notwithstanding, UNH is the poster boy for maybe not getting your bills recognized by your insurance guy. It's not all their fault, really, from my understanding of how that system works down there. But, I would personally, I think Walgreens may be a shot for a turnaround, and apparently there's some activists who think the same way. But I'd probably stay away from UNH. It might be the cheapest stock on the board in that segment, but I just don't know. I just don't understand it, basically.
All right, let's get to our pro picks. These are John Zechner's top ideas, stocks that you should be investing in today. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment, corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pick, John, is Cenovus Energy. And I'm curious about why you're picking Cenovus. It's down compared to oil prices, which are up. So I wonder if that's kind of the first obvious opportunity.
I think they're less impacted maybe by the potential tariffs because they get refining in the U.S., so they can get across and they can sort of hedge their bets a little bit more that way. But I think all of these oil producers, I could have gone with them or Varen or Baytex, or you could go upscale to CNQ. I mean, these things are trading at 3 times operating cash flow, and I just assuming a really worst case scenario for oil prices going forward, I just don't think we're seeing it.
What's interesting about Cenovus and even CNQ is they've both underperformed oil. But they've also underperformed Suncor. And I wonder if Suncor is just taking the investment dollars away from some of these companies just because there's an operational turnaround there as well under Rich Kruger.
I think you got to roll the clock back on that one a little bit more because Suncor had underperformed for, probably 10 to 15 years when you look at it. I mean, I think Suncor hit $73 or something like 20 years ago, and they've been struggling. And recently they started closing that gap a little bit more. So on a shorter term relative basis, the others have done better. But the group it's either a buy or not. I just tend to think that people are too pessimistic about peak oil, and the valuations still stick out in Canada. And if the market doesn't ultimately reward them, I think they will just start buying one each other, and that's how you ultimately recognize the value. At the same time, they're going to buy back their own stock and increase dividends. So.
What I like about you, John, is a lot of people for Pro Picks will bring charts that are already moving up and to the right and say, yeah, you should buy there. But you're looking at those charts that are maybe languishing a little bit. And that's true of your second pick, which is Maple Leaf Foods, trading around the lowest level since 2022, though recently it's had a bounce. What do you like about Maple Leaf Foods right now?
It's not exciting business necessarily, but just doing a few things right. We talk about cost restructuring. I mean, they're getting the margins higher in some of their products that go into the stores as well. There's because consolidating and integrating right down to the consumer level, and they're getting rid of some of the businesses. I mean, they're spinning out Canada Packers and like that hog bits and all, which has been the most volatile parts of it. That's going to shareholders this year. They're improving the rebate margins, and the valuation is as low as we've ever seen it. And they still have the plant-based proteins business, which is losing money but getting closer to break even. I think there's still some growth in that down the road.
You like it for plant-based proteins? I felt like, isn't that over? That fad?
Maybe. I don't think so. You're still plenty of vegans out there and all of that. So. I don't know. I had steak for dinner last night. What am I saying?
We're sitting next. Are you vegan? You're vegetarian.
I'm a vegetarian, but I will. Yeah. I mean, I think most vegetarians.
Do you like any of that stuff? That plant-based stuff?
No. I mean, I've had a veggie burger, but it's not. I mean, if I don't eat meat, I don't want stuff that looks like
true. That's true.
Like meat. And what was that Beyond Meat? It had blood. It looked like blood. I mean, that did not make sense to me at all.
Your third pick is Uber, and that's super interesting right now. Why is Uber screening as attractive right now?
Well, on a total aside, I always love it when a company sort of becomes a generic for the name. You can go back to, Kleenex or Fridge or something like that, and you certainly go to Google. And now you want a ride share, you say, I need an Uber. It's like, so that's an aside. But clearly, they're generating positive cash flow. They're growing. They're trading at a decent multiple. And then I started going to full self-driving. And I keep looking at Tesla, and I shake my head at the valuation. And maybe it's an Elon thing or whatever. People, full self-driving is what all the value is in Tesla stock. I keep thinking, come on, I don't know that that's true. They have zero miles of full self-driving.
Right now. That's insane. The stock has added billions in value just because he's friends with someone.
You look at Uber, on the other hand, I thought, okay, I may not want full self-driving in a car at any point. I just, I can't see most people sitting there and not wanting to have their foot on the gas or the brake or the wheel or whatever. But, taking an Uber somewhere in an automated vehicle, I'd do that. And I think, and you see it now, because the most important thing is who's been the most successful in full self-driving so far? Who had done Waymo.
Yeah.
Nobody's done more driven miles than Waymo, and Uber has just done a deal with Waymo in various cities where they basically provide the software in order to get the Waymo vehicles there. So I think there's so many growth potentials there at a reasonable multiple. So it seems like a good story in tech and consumer.
Goldman Sachs, who has Uber on their conviction buy list, talks about Uber being the third asset-light vehicle provider for self-driving cars. The third ownership. So there's going to be that opportunity for Uber to leverage their cars into maybe the Waymo network. I agree 100% on Uber. I own the stock.
Guys, this was so much fun. Thank you so much for joining me.
Thank you.
It's always great to talk.
Now, before I let you go, we do a little fun thing here at In the Money just to thank our guests for coming. We give you some swag.
Oh,
some
I
cool
like
stuff
there you go.
Yeah. Now, it's custom, and it's kind of to match your personalities. So I'll go, John, you get just kind of the classic one. I own this hat, so that's how you know it's cool.
Okay.
Isn't that cool?
That is good.
So I'll take it. Why don't you put it on? We've got the EBITDA hat.
There we go.
For John Zechner, because he likes to look at those low valuation stocks. And for you?
Girls just want to have fun. Oh, that's funds.
Fun is nice, but funds is even better.
Oh, thank you.
You're welcome.
Yeah.
Thank you. I appreciate you guys coming down on a chilly day.
Nice to be here.
We're so happy what you're doing, and wish you all the success.
Thank you so much. That's John Zechner and Frances Horodelski.